Hi everyone, in this video we'll be discussing 10 best covered call ETFs in Canada. These ETFs offer interesting dividend yields. That's why they are quite popular. In this video I will discuss what a covered call strategy is and also why these type of funds are popular. And we'll go over 10 of the most popular dividend ETF and discuss each one of them. So reasons why covered call ETFs are popular. First of all, how do you know they are a covered call? Just look at the name, like you would say covered call, Vanguard covered call ETF or BMO covered call ETF. So usually the name will indicate it's a covered call. And three reasons why they are popular is first of all they offer high dividend yield. So in a classic dividend ETF, the manager has a bunch of stocks in his portfolio. When these stocks pay dividends, these dividends are in turn paid to you minus the fees. For covered call ETF, dividend covered call ETF, what's going to happen is that same thing. The manager owns a bunch of stocks. They will receive a dividends, but in addition to the dividends, the manager on the side, let's say on 30% of the portfolio, 30% of the stocks that he manages, he will issue call options. By issuing call options, he earns premiums. So you are being paid a distribution that's dividends plus premiums from call options. So that's why the dividend yield or the distribution yield is much higher than a regular dividend ETF. The second reason why they are popular is their low volatility. If you notice, if you've been following these covered call ETF, you will notice that issuers or influencers, they're pushing these ETFs because the argument is that it's beating the S&P 500 or it's beating the TSX, which is true because when you apply a conservative strategy like a covered call option, you will definitely fall less than an index ETF. An index ETF, if the stocks goes down, it will just go down, or a dividend ETF, the same thing. But for a covered call ETF, it's different because they are issuing on a monthly basis call options to protect the portfolio from the downturn of the market. So if the market is losing value, a covered call ETF, let's say, if covered call ETF loses 3%, usually the market is down by 10 or 11%. So it's protecting you from huge losses that usually happen in the market during high volatility. Again, also, I just want to mention that high volatility increases premiums also because there is more room to negotiate the strike price. So when there is high volatility, usually these funds do well because they earn more premium and also they protect you against a loss in the market. It's the third advantage is that they're great for passive income investors, and I think it's one of the reasons why it's super popular. People are looking for passive income, and they are using these kind of funds because of the high distribution. Now that's the advantages or the three reasons, but I want to go over them again, but just explain the risks. So you have a high dividend yield. Yes, it's true. But you're giving up potential growth because what's happening is that by issuing call options, the manager is giving up growth potential for these stocks. He's willing just to take the premium and a little bit of profit or a little bit of loss. So thus he's protecting you from volatility, but at the same time, the good volatility that you want, which is like the stock rocketing or going up, you're not getting that because you're giving up on the growth potential. So keep that in mind. You will have a high dividend yield, but the performance of these type of funds is generally not attractive at all. If you look at the total return, which is the performance of the stock, the performance of the ETF plus the yield, the dividends, you will see that the total return is not really interesting at all. Actually, a regular dividend ETF does way better than a covered call ETF in the long term. So the covered call ETF will be a good thing only when we're in the situation we're living right now. The market is going down. So you're kind of protecting yourself from the loss of the market and getting some dividends at the same time. But if the market starts picking up, you have to sell your covered call ETF and just embark on an index ETF or a dividend ETF. So that's one. That's the one aspect regarding the high dividend yield. The risk there is that you're losing potential growth. The second one, which is low volatility, that one is true. Like it will be less volatile than a regular dividend ETF. However, I read somewhere that the covered call ETFs are good at protecting you from downturn markets. So they kind of protect you a little bit. So if the market goes down 10%, we're going down only 3%. However, this research that I read is that when the market picks up, it's not the same kind of, it doesn't work the same way. What they notice is that when the market picks up, let's say the market goes up by 15%, these ETFs will only go up by 3 or 4%. So what they're noticing is that they are good at downturn, protecting you from the downturn. They're really good. But from when there is the market starts picking up, you're not getting a lot of the growth potential. You're losing a lot of that growth potential. So that's one risk there, and it comes again to the growth potential, the long term. You're not going to be in when the market picks up. Great for passive income. I think it's obvious. I mean, if your main objective is to get income, so you are close to retirement or retired, a covered call ETF may be a good option to add to your portfolio. But if you are still young or still building wealth, then it's better just to stay with a dividend ETF or an index ETF. That's because you are in for the long term. It doesn't make sense for you to earn high dividend yield and give up on potential growth of stocks, which we know, and also in tax wise, a capital gain is better than having a dividend being taxed for receiving dividends. There's the argument, some people were arguing, well, a covered call ETF, if you reinvest the dividends, then, well, why I'm gonna do through all that hassle? I mean, just stay with a dividend ETF. Why? If the main purpose is to gain passive income, why I am reinvesting my dividends? It doesn't make any sense. And if you look at the long-term performance of these funds, they are unable to beat a classic dividend ETF. That's because of the covered call strategy, which is a conservative strategy. So these type of ETFs are great only if you're short term and you just want that payment cash coming in every month, or so you're relying on that dividend distribution. But if you are long term, definitely it's not a good option for you. So can you lose money on a covered call ETF? The short answer is yes, because covered call ETF are volatile and the returns depend greatly on the performance of the portfolio of stocks that the manager manages. They are not like a bulletproof. They're still, if the market goes down, it will go down. So definitely that's something to keep in mind. So you can lose money on a covered call ETF. Now, the list of the most popular ones, there is a bunch of them. There is ones that are offered from BMO. I think they are the most popular. And if you look at the asset under management, they are well above 1 billion. They've been in existence for a long time. So we have access to long-term performance of these two ETFs. So this is ZWB, BMO covered call Canadian banks. This is invest in Canadian banks and issues covered call ETF. This one is ZWC, invests in the Canadian economy overall, much more diversified than ZWB, and uses a covered call strategy. The third fund from BMO again is BMO Europe High Dividend Covered Call ETF. It invests in European stocks, in select European stocks, and uses a covered call strategy to protect you. We'll see here that the MER is around 0.7%. They are pricier than a regular dividend ETF because the manager is more active, issuing all these call options, studying the market, anticipating the movements and all that. So that's why the MER, the management expense ratio, is a little bit higher. There is also the BMO US High Dividend Covered Call ETF. I think it invests in a selection of US stocks with a high dividend yield, and they are using also the covered call strategy to enhance yield. Another one from BMO is for the US banks. So same logic, invest in US banks and use a covered call strategy. Then we have Harvest Tech Achievers. This one invests in technology sector. So if you're interested in a technology sector, it invests in technology sector and tries to earn as much premium and dividend as possible and applies the covered call strategy. There is also Harvest Brand Leader Plus Income. So it's select companies of businesses that are known for their brand and being a brand leader, and they apply the covered call strategy to enhance yield. There's one also for the healthcare, same idea. And there's two here that are starting to become really popular, which is Harvest Diversified Monthly Income ETF and the Hamilton Enhanced Multi-Sector Covered Call ETF. These two ETFs offer really a much superior dividend yield than the one we discussed here. That's because in addition to being a covered call ETF, they use leverage to enhance even more the yield. So they're a little bit more aggressive about this strategy of covered call, whereas the ones from BMO, these two are popular. They're not using the leverage to enhance the yield. These two are using leverage, and they're becoming popular because the leverage enhances even more than dividend yield, which you will see here. HDIF and HDIV have a dividend yield of 9.28, 8.91%, which is really high in comparison to the other ones here. My personal favorite in terms of covered call ETF is ZWC from BMO. It doesn't use leverage. So for me, as someone who doesn't like to take too much risk, ZWC I think is better because it just uses the covered call strategy. It doesn't embark into leveraging. It's also diversified, the whole Canadian economy. But the long-term performance is around 6.91%. ZWB, which invests in Canadian banks, is doing better at 9.24, 8.38. We all know the Canadian banks are strong, and also they are strong, and they usually post they're solid financially also, and they have excellent results in the long term. So ZWB will be also a good option. It does not use leverage, but if you are into the high dividend yield, then these two are also a great option, HDIF and HDIV. And the other ones are more sector oriented. So if you are looking for US stocks in particular, or technology, or more diversified European market. So as you can see, each fund, just try to read the strategy to see if that's something that fits your portfolio overall. But the idea here is that there is a bunch of them. Some of them we have historical performance like ZWB, ZWC, and it's not that bad. Like it's really a great performance, and you have an extra dividend yield. The new ones, HDIF and HDIV, we don't have yet the long-term performance there because they've been created just for less than a year, I think. So that's why we don't have yet the performance. But you can visit the issuer website to get more detail and information regarding these two funds. And I think they're using 25% leverage. So they are adding 25% leverage. This allows them to reach this interesting dividend yield. And all these funds have done well during this last 1 year, 2 year. They're doing better than the market because, as I mentioned, they're using this conservative strategy of covered call option. So ZWC is a great option if you're seeking a diversified ETF that invests in Canadian economy. It has an attractive yield. Since it's a covered call ETF, it was less impacted by the recent correction in the market. The long-term performance is decent. HDIV and HDIF are strong competitors to ZWC. They are diversified across various sectors. They use covered call strategy plus additional leverage to push even higher dividend yield. Since these two ETFs are relatively new, their performance and MER are not yet published, but one can assume that it will be a little bit more pricey or expensive than ZWC. But again, we'll have to wait and see. But I think it will be just a little bit higher. And the additional leverage, as I mentioned, used by these funds enhances the yield, but also creates more risk for investors in the long term. ZWB is an excellent option if you're looking exposure to the Canadian banks. If you're missing Canadian banks and you're worried about their performance in the short term, you can invest in ZWB to get the dividends and wait till the Canadian bank starts picking up and then invest in banks directly or a regular dividend banking ETF. ZWH is good if you want to invest in US dividend stocks. It has companies like Apple, Microsoft, and it offers also an excellent sector diversification. The brand Harvest brand fund is also a good choice. Same thing, US corporations, and it's well diversified. HTA is for technology, so companies like Amazon and tech stocks. But it's the one that's more volatile than the other ones because of the nature of tech companies. So it will depends on you really. Like, I mean, at that level of volatility, I rather just invest in tech stocks or a ETF that invests in tech stocks directly than owning HTA. But it depends on each person on the level of risk tolerance. HTA is a good option if you're more conservative and you still want to take advantage of tech stocks. And finally, life is good if you want an exposure to the healthcare sector. So all these ETFs pay a monthly distribution. So what I want you to keep in mind in this video is that these products are really great. Like covered call ETFs are great. It's just you need to know how to use them. They are more of a tactical play because now the market is going down. If you think it's going to go even lower, then a covered call ETF is a good option. You're protecting yourself against the downturn in the market. You're earning dividends at the same time. If this fits you, then it's good for you. However, if you are more long-term, probably it's better just to stay with a regular dividend ETF or an index ETF. If you are long-term and you want growth, you just don't want just the dividends. Always focus on total return, so dividends plus the capital gains you're making. Not just look at the dividend yield, because this is what I notice. People focus too much on the dividend yield. They see 10% and they see that the performance is now better than the index. They think they own something special. But when the market starts picking up, they will realize that the covered call ETF is not really a good option when the market starts picking up, because it's not going to pick up. It's going to pick up, but really slowly compared to the market. So that's why if you are long-term, it's better just to stick with a regular dividend ETF. But if you are short-term or you just want cash, you're already retired or close to retirement, a covered call ETF, I think, is a good option. I hope this video answered some of the questions regarding covered call ETFs in general. And I encourage you to do, of course, your own research. So thank you for watching the video. Please like, share, and subscribe, and visit my blog if you want the full details, the full article post there with all the details. Thank you.